It wouldn't shock me if you go way past 200 even. Now, maybe the reality, for instance, Eric Sprott, it was most influential guy in the silver market, has expressed the view, and it probably ought to be 200. And that's simply, going back and looking, if it was 50 in 1980, and if it was 50 in 2011, if you merely factor in the ongoing decay in the real value of the buying power of the dollar, which remember, it increases in quantity about 80% every decade. Okay, so, I probably said this before in talks with you, that when your granddad built a house, it was $4,500. Your dad built one, it was $45,000. And if you want to build a median home price now, it's $450,000. That expresses the ongoing decay in the money unit. Very important two charts that we're looking at. Neither one of them are simple price charts, which everybody is deluded by one way or the other. That's why there's a chorus of folks still calling every time the gold flinches, it's got to correct, et cetera, or it's the top. There is a relationship between gold and the S&P 500, or the U.S. stock market bubble, and you can plot it. It's called a spread relationship. We simply divide the front month of active contract of gold futures into the price of the S&P and express that as a percent. And we plot it, okay? Every end of every month, we plot one little dot, okay? When you plot that chart, we've shown it in prior reports, you've got a 11-year wide base on that chart, where gold back in 2011 was at a higher relative level to the S&P. And during its bear market, 2011 through, especially 2013 through 15, gold dropped, but also its relative performance dropped to the S&P. But then actually since 2014-15, you could basically take that same spread chart, draw a line sideways, and gold's been above and below and above and below. It's really been par to the S&P. Depends on when you bought gold relative to the S&P, you're doing better. Now, especially since 2024, that spread has moved up sharply.
If the gold S&P spread were a stock chart without labels, investors would likely view it as a powerful breakout, one too obvious to ignore. Yet many analysts misread gold's recent strength as overextension simply because they're focused on raw prices. In reality, the relative performance data shows accelerating capital rotation away from equities and into monetary metals. Institutional investors, long skeptical of gold, are quietly increasing their exposure. With the spread now trading above its multi-year base, the movement is less a peak and more the beginning of a broader asset class shift, echoing similar transitions seen during previous equity downturns.
Now, when you look at the spread chart, there is a massive, very clear line across every single rally high that relative performance surges have created. So you could take a crayon and have a 5-year-old draw the line for you. Unfortunately, most people don't plot the spread chart. And if you did, you would see that this month's close, we have a half a day trading left, I think on Friday, is out above that base. Meaning that while gold has handily beat the S&P, especially since 2024, coming up from the lower end of that base, it's now punched out above it. So if you're just looking at that chart, and I erased the words gold versus S&P and didn't tell you what it was, and you thought, well, that's a price chart of some stock, you'd say, I got to buy that thing, okay? Because you break it out of a base that an idiot could see. But everybody thinks that gold has gone too far, it's got to correct, or it's excessive. And that's because they're focused on what? A simplistic price chart. And when you run a relative performance chart, it's saying not only has money been moving into gold since 2024 soundly, solidly, it's now breaking out, meaning that the money flow that we've seen coming out of doubters in the stock market, some large skeptical asset managers, let's assume, who've said, hey, I need a little bit more in that monetary metal sector, okay, and they've been, a little bit here and there. It's helped gold go up. But when you break that spread out, and you're doing it this month, we're at levels now that are credibly above that breakout point. It says, hey, it's just beginning. This relative performance asset shift out of the stock market into monetary metals is only now beginning. So those folks who've been tell you that, oh, this has gone too far, too long, et cetera, they need to look at that chart because it says something totally different.
A second chart adds even more intrigue: the silver versus gold spread. Unlike traditional price comparisons, this ratio highlights performance leadership within the monetary metals sector. Silver surged dramatically in 2020, faded in the years that followed, and then began climbing again in early 2024. Now it is pressing against the top of its own multi-year base. Historically, when silver outperforms gold during periods of monetary stress, it signals strong speculative and industrial demand. Today's breakout levels suggest that silver is no longer the laggard. It is positioning itself as the primary leader in the metals market's next major move.
There's another chart we can talk about if you want to, unless you want me to pause a bit here. If you plot silver versus gold spread chart also, where you don't look at the price of silver, you don't look at the price of gold. Instead, what you do is you divide the futures contract December silver right now into the price of December gold, and you express the answer of that as a percent. You'll see that we've developed a spread chart basing action, much like that gold versus S&P basing action, where, silver's had a surge back in 2020. You recall that move where silver went from like $15 to 30, and gold only went up about 40%. Well, silver outperformed up through late 2020. And then we went into that multi-year period where, gold went sideways through early 2024. And silver and the miners actually sort of declined in relative performance. No, they were going up. There was a rise, net rise there, but they were underperforming gold, the mono metal. Silver has been surging versus gold since early this year, about April. It's really come up sharply on a relative basis, so it's been a better place to be net on balance for the year. But you're challenging now a massive spread breakout base, where not only is gold saying, I'm going to break out versus the stock market, silver saying, I'm going to break out versus gold on a relative place to be. And so if the monetary metals are now moving into a fresh, massive asset class shift versus the S&P, the U.S. stock market, silver is also saying the same thing, except I'm no longer going to be the little dog that follows behind gold. I'm going to outpace gold. So if you're going to shift to monetary metals now, and if you're not in these markets, for example, a lot of people aren't, I'm suggesting, MSA is arguing that the metrics that we're talking about here are saying something big is about to begin in terms of asset class shift, favoring monetary metals, but especially silver. And it's starting now.
Silver's strength is often magnified in the mining sector, where price moves frequently exhibit multi-bag potential. With silver pressing toward the mid-$50 range, mining stocks, especially juniors, have begun outperforming both silver and gold. This is notable because the silver mining industry is tiny. When institutional money begins reallocating even modest amounts away from overvalued equities, these small-cap miners can experience explosive upside. Historical precedent supports this behavior. In early bull cycles, miners can gain several times more than the metals themselves. Current technical patterns suggest that silver miners may be entering such a phase right now, setting up a potential year-long leadership run.
We've seen congestion in silver since October. So we've had 2 months of they sell it, they drop it down, goes back up. They sell it again, drops back down, goes back up. And now for the third time, we're pressing up into the lower 50s. We're $53 now. By the way, we'll rotate our analysis now to March silver starting the 1st of December, when December silver goes into delivery. Also, we'll be shifting out of December gold and shifting to February 2026 contract. And already, when you look at the March silver, it's up to 53.5 area, meaning it's almost ready to touch top tick again, which is 54 in that recent rally on a $1 scale. But that's not the issue to us. The issue to us is that relative performance breakout, gold, S&P, and secondarily, silver says, okay, yeah, the monetary metals are going to go up, but this time I'm not going to be behind you. I'm going to lead. And I think the same applies to investors who don't want to necessarily buy silver futures or calls on silver ETFs, bullion ETFs, or buy silver bullion. They want to buy miners. They want to buy stocks. We technically analyzed that highly likely that not just in the immediate surge we're about to see, and remind me to get back on that subject again in the next 6 months, but over the next year or so, the miners will be gold as well, especially the silver miners relative to the gold miners. So when I speak personally, and I show my position in every report as a disclaimer, I'm heavily into silver related. Calls on SLV, double long AGQ, which is a bullion ETF, but also silver miners.
For half a century, silver has repeatedly failed to break beyond the $50 zone, touching it in 1980, 2011, and again in recent rallies. Meanwhile, other industrial metals like copper and lead escaped their decades-long ranges by explosively quadrupling in just a few quarters during the 2000s. Silver's stagnation defies economic reality. Monetary debasement, growing deficits, rising geopolitical risk, and accelerating industrial demand, especially for solar, EVs, and grid technologies, have not been reflected in its price. Technical structures now mirror the exact basing pattern seen in commodities right before parabolic breakouts. Silver appears grossly undervalued and overdue for revaluation.
And I'm buying a lot of junior miners now, silver miners, because I think they could be hotter than silver, much hotter. They're extremely neglected. It's a very tiny little sector. And when the hands come in to buy it, money fleeing the stock market or deciding it's a better place to be, monetary metals, those little miners just go vertical. I've seen a lot of days lately where silver's up 2% and they're up 5%. Okay. So I think that's what's going on. But as far as silver, it's in a fairly unique situation, has really partly to do with this broader view of monetary metals going up. But think about this for a minute. Silver's been stuck in a range, $50 highs in 1980, 2011, and even recently either side of 50, for 50 years. What's going on here? I can go show you a chart of copper. Go back to the 70s, 1980s, 1990s, into 2000. And in 2007, after multiple decades of horizontal reality for copper, it broke out, and within a couple quarters, it quadrupled in price. It's late 2005, 2006. And yeah, there was a sharp sell-off after that, but you then, hence, after that surge, a quadrupling in price, you lived in a multi-decade range that is like 3 to 4 times the average price of what prevailed the 70s, 80s, 90s, 2000 for copper. Same is true for lead. Very exciting metal, right? It lived in a multi-decade range, and in 2007, not in sync with copper, a year and a half later, it quadrupled in price in a couple quarters, and since then has lived in a range that's roughly 4 times the price average of that prior multi-decade range. Why is silver still stuck in its 50-year range? Well, there's fundamental arguments for that. Manipulation, attempt to control by some major banks, no doubt with the nod of a head from the Fed and so forth. But when a market makes a mistake, like we've seen stock market bubble tops, and that's when the stock market makes a mistake of, let's say, going too high for too long.
Silver's long suppression has created a false sense of stability. When markets stay artificially low for too long, the eventual adjustment can be explosive. Analysts argue that silver could quadruple or even quintuple in just a few quarters once its spread breakouts confirm. A move toward $200 is not speculative fantasy. Adjusted for 40-plus years of currency debasement, it represents a return to the metal's former purchasing power. With global capital shifting away from fiat-denominated assets and into monetary shelters, silver may lead the next major commodities supercycle. The next few quarters, not years, could redefine the entire precious metals landscape.
Even though the truth underlying the bubble is valid, it's overdone it, like the dot-com high. And so when it corrected, quote, corrected, S&P back then dropped 50% by 2002, but NASDAQ 100 collapsed 82%. Despite the truth of the reality of internet changing our lives. It was excessive for too long. Silver, we argue, has been in the same position except on the downside. It's been too low, too contained for too long, and when it finally unleashes, what happens in those type of events is when a market has created a false reality, fooled people into thinking that's where it deserves to be, and when it wakes up, it not only goes to a new reality, but it often overshoots it. And it doesn't take years to get there. It often takes just a couple quarters of a massive tantrum. I think that's what silver is about to produce. Meaning, not only is it going to beat gold, not only are monetary metals going to beat the stock market, but silver could quadruple or even quintuple in a matter of a couple quarters after that spread breaks out, registering the breakout silver versus gold. Meaning, we might go up for a couple more years and probably stay up there because the world is going to shift out of fiat currencies in this next crisis, is our argument. But just getting there could be a stellar event for silver. And so we're telling people, if you want to get into monetary metals, put some emphasis on silver because you might be stunned and smiling greatly at what it does in the initial couple quarters of that move. And I think we're right there. We're right at the doorstep. It wouldn't shock me if you go way past 200 even. Now, maybe the reality, for instance, Eric Sprott, it was most influential guy in the silver market, has expressed the view, and it probably ought to be 200. And that's simply, going back and looking, if it was 50 in 1980, and if it was 50 in 2011, if you merely factor in the ongoing decay in the real value of the buying power of the dollar, which, remember, it increases in quantity about 80% every decade. Okay, so, I probably said this before in talks with you, that when your granddad built a house, it was $4,500. Your dad built one, it was $45,000. And if you want to build a median home price now, it's $450,000. That expresses the ongoing decay in the money unit. The same is true with the yen, euro, a lot of currencies. They continue to decay because the central banks print to fund the governments. Well, silver hasn't expressed that yet. If it were to simply express a price equivalent to $50 back in 1980, I haven't done the math, but I'm sure it's 200 or higher. So, you can make that case, sort of a broad fundamental. But what I'm arguing is it's likely to do it very rapidly, not incrementally. And that's the key right now, I think, is now. Don't think out 2-3 years. Think of what could likely happen in the next couple quarters.